The deadline for contributing to an RRSP for the 2020 tax year is fast approaching, and Peter Cishecki from Everything Financial joins us this morning with some RRSP strategies to make sure that we're getting the most out of our investments. Good morning, Peter. Good to see you.
Nice to see you, Carrie. Good morning.
Yeah, so how do we start off? How do we know what our contribution limit for an RRSP is every year?
Well, you have to look on your last year's notice of assessment, that form they send you back when you complete your taxes from the Canada Revenue Agency, CRA, and on the bottom it will have what your contribution limit is, which is really based on 18% of your previous year's income to a maximum of $27,220. $27,230, but also unused contributions from previous years get added to that. So that could significantly increase what you're allowed to deposit to an RRSP.
Yeah, if you don't max out every year, as the term max out, then it gets carried over.
Absolutely.
So what happens if you do contribute too much?
Well, there's two ways to contribute too much in my books. This is my opinion. The one is go over that CRA limit. They give you a $2,000 of grace, but over and above that, there's penalties and interest charges. But I have another way of you can do too much, and this comes up all the time. So let's not focus on the CRA limit. Let's focus on what your tax bracket is. And you can contribute too much, in my opinion, if you put yourself from a 38% tax bracket, say down to a 32% tax bracket, yes, you're going to get dollar-wise more money back, but percentage-wise, you're getting considerably less, 6%. And some people even do it more than that, where they drop 2 or 3 or 4 tax brackets. That means less bang for your buck and less percentage refund CRA has to give you.
Yeah, some different ways to look at it. How important is it, though, Peter, to have a plan for investing in RRSPs? Do you find that some people are lured into impulse buying RRSPs? Is that even possible?
Oh, absolutely. It's possible. It happens all the time. And we talked about this last week. We won't get into Valentine's Day again, but people look at RRSP season. All you ever hear about is RRSP season. There's no such thing as RRSP season. It's been pushed down our throats from the big banks and the big salespeople and the mutual fund companies for 30 years now. RRSP season starts at the beginning of the year and ends at the end of the year. So that's the importance of a plan where you're putting away, they call it dollar cost averaging. Have a plan to put away monthly or bi-weekly so that you get close to what you need in RRSPs by the end of the year. And that's the key. How much do you need to reach your goals? Maxing out RRSPs isn't a goal. It's an impulse purchase. Have a plan, because a lot of people do very well at retirement, have a very good plan, and they never get close to maxing out their RRSPs. It's just a sales play.
Maybe a little bit better idea. And we did talk about this last week of putting some money aside every month and contributing that way. So when the end of the year comes, you aren't, scrambling to buy extra RRSPs, maybe end up over-contributing as a result.
That's right.
It is Random Acts of Kindness Day, and I like what you do. Tell us about some of the good karma that you're putting out there, Peter.
My good karma, oh geez, put me on the spot. Well, my good karma is a couple times a week as I'm in the line at the coffee shop, I pick up the bill for the person behind me. Sometimes just do it just because, and a little bit of paying it forward and putting a smile on someone's face every day.
Yeah, you're investing in good karma. I really like that.
I try to, yep.
That's financial sense. Peter, thanks for joining us this morning.
Thanks, Carrie. Have a great day.
Yeah, you too.